How are you?
I'm Adam Rutledge. I'm the Rutledge and Rutledge Property Group, and this is Mike Newman. Newman Group at Home Loans? Evergreen? Yeah, so we're just kind of doing a Q&A. The real estate market is changing and has changed pretty rapidly. So on most of your guys' tables, we're making more now. There's some of the talking points we're going to go over. Whatever it is, real estate, finance, business related, we're just kind of here to chat. And then if no one has anything to say, then I've got some stuff we can talk about. Mike, anything you want to add?
No, I think it's a good place to start.
Cool. So the first thing you have basically says, if buying a house is financially doable for you now, you should do it. What do you guys think of that? Think I'm crazy? No? Yes? So that comes down to a lot of people are thinking the market's going to crash, but a lot of the experts come on in. We're seeing prices may come down maybe 5% next year. But the problem is if interest rates keep increasing, the cost of your house is going to continually get more expensive, even though prices will soften a little bit. Mike, you want to talk about the relationship between mortgage rates and the monthly payment? Like, what does a 1% increase do?
Yeah, I wish I knew that off the top of my head, but it's going to be a lot. 10%, you know it off the top of your head. So it makes a big difference as these interest rates, if they continue to rise. It's changing things for everybody, but most certainly our first-time home buyer people that are trying to get in the game and they're getting priced out because of the rates. So
yeah, and it's happened pretty rapidly, and that's whenever interest rates increase, you're going to see downward pressure on property values. So one thing, a lot of the conversations I've been having is if you're thinking about selling a piece of real estate in the next 18 months, the best time to do it is now. The best time before now was 2 months ago, and the best time before that was 2 months ago. But as the market is softening and you're thinking, hey, maybe you're moving out of state, you've got some financial reasons to make a change. If you're going to sell, I would recommend doing it sooner than later. And then when it comes to buying, it really has to do with what we think interest rates are going to do. What do you think rates are going to do?
I mean, the crystal ball that I wish I had, and we all wish we had, right? Speculation is that this could continue, although we did see things ease back today in a really nice manner for the first time in quite some time. But it has been on an upward trend now for months and months that we all know. We're hearing about it in the media, all that kind of good stuff. So,
what did rates do today? I didn't know they did anything.
Yeah, so rates, I probably saw the biggest rally that I've seen in, I don't know, probably at least 8 to 12 months in the marketplace. And that's because the CPI, Consumer Pricing Index, came out today, and it was really positive for economic news, and so that rallied things a bit. Now, does that mean we're turning a corner and that's where things are going to go? I don't think so, because we still have a government and a media that's out of touch with reality a little bit, and until we start to catch up with that, I think we're going to see major volatility in the marketplace in regards to interest rates, and that's just going to be a fact of life. So, how long are they going to continue to increase, and how high do they increase? Magical question. I wish I knew the answer to that, but I think there's the owner of our company, Evergreen Home Loans, he thinks that things could get a lot worse before they get better in regards to interest rates. Other people are saying, oh, no, they're not going to. They're going to get better sooner than later. So again, nobody really knows. There's some speculation it could go. We could see 8, 9%. We flirted with 8% really recently. Earlier this week, in fact.
And actually, I can tell you why. Dave, how long have you been building houses for?
40 years.
So Dave Hammond's been building houses for 40 years. And when did you buy that house that you're working on?
Oh, one house?
Yeah. So Dave buys a house to fix up and flip. And he told me, just watch, as soon as I buy this thing, I'm going to crash the market. And so you can blame everything on Dave. He started it. And we can say now, like with somewhat confidence, that the top of the real estate market as far as values in volume of sales was April. So you did it.
I did.
I called him a couple weeks ago joking about it. It was like, one Hammond's house just. And if you look at page 2 of the attached, we're hoping that most of the rapid increases in interest rates are over. But then the question becomes, what's like the new normal going to be? And if you look at your third one, this is my favorite one. Who here owns rental properties? So if you look, this is the median rent since 1988. It was flat during the last housing crisis, maybe decreased slightly. So if you own a property and you can't sell, let's say you're like Dave and you bought it in April and the value slid a little bit since then, you can always rent it out. Because typically, especially if you bought something back then, what were mortgage rates in March, April, May? They still in like fours?
March, yeah, 4.5%, somewhere in there. Yeah, a lot lower than they are now.
So there's a good chance that it can rent for more than the payment, which gets into why we're not really seeing much as far as foreclosures go, because I'm thinking it's more going to be like the Great Freeze. So let's say you bought your house in 2020 for $400,000. By 2021, it was probably worth what, 440? Was about 10%. Mm-hmm. So your house is worth 440, but you locked in an interest rate, say at 3%. So if you were to go buy that same house, even if it was at $350, but the rate 7%, the cost of owning that house on a monthly basis is significantly higher. But you can also rent it for more than your payment is. So that's why we're not seeing foreclosures. Is the average homeowner in America has significant equity. Just got quiet. And significant equity is defined as 20%. So if you have a $400,000 house, you bought it a couple years ago, there's a good chance that you have at least 20% equity or $80,000. And if your payment's super low, your payment is lower than what you could rent that house for, you're not going to stop making that payment, because if you're to go move somewhere else, it would actually cost you more money. Does that make sense? So even if you are a little bit concerned about what prices are going to do, you got a great interest rate, and there's a lot of value in that. You know, because when rates went from 4 to 5%, your $2,000 mortgage went from $2,000 to $2,200 a month. And then when they went from 5 to 6%, your mortgage payment would have gone up another $220, so $2,420 a month. So that is what rates are doing, increases the monthly cost a lot. So if you've locked in a low interest rate, who here's bought a house in the past 10 years? You got a great rate. So it's a proudly raising the hands. If you have a great rate, right, the question is, why would you sell? So if you need to sell, now is the time. But for the most part, if you can hold on, because everything's temporary. Anyone else been through any economic cycles in their life where it was good, and then it was a little sketchy and it got good again? Yeah.
I mean, this guy said one thing to me that I've never forgot. He said, you know what? You never hear about people who wished they never would have bought that house. What do you hear him say? I wish I would have bought sooner, never sold it, maybe. Okay, so what he's saying is retain. If you can keep it, retain it, and maybe you're going to move on to something else, or buy a rental property, or maybe you rent that to buy a new primary, whatever it is, if you can afford it. I think that's what you started with, if you can afford it.
Yeah, if you can hold on to them. So is your house going to be worth more next year than this year? I don't know. Good chance it may stay flat. Anyone need one of those? But what's it going to be worth in 15 years? Or what was your house worth 15 years ago, 20 years ago? I remember, my parents telling the story like, we bought a house in the 80s. The interest rate was 18%, but it was $30,000, right? They bought a house in Bend for $30,000. Now it's worth $700,000. It would have been nice if we just held on to that puppy, right? Because rates would have come down. You could have refinanced, and the thing shoots way up in value. So over time, real estate is the number one best way to accumulate wealth, especially if it's rental real estate, because you have all of these factors occurring. So you're getting money coming in. You get to write off the interest. You can write off any repairs that you do to the house while someone else is paying the debt down. And you can depreciate it on your taxes. So what depreciation is you can devalue the house according to the IRS's rules as it goes up in value. And you can knock that off of your taxable income every year. So if you are a mortgage, I don't know if you're a real estate professional, so if you spend more than 750 hours a year in the real estate space, either managing it, constructing it, fixing it, being a landlord, you are what's considered a real estate professional by the IRS. And that means that you can take passive losses. And that is like one of the best things about real estate is the ability to depreciate it past what it actually cost you and save a ton of money. Should we dig into that at all? Anyone interested in how that works? April's like, I know. Anyone here own rentals and need to do write-offs? Aaron in the back. Okay, so if you buy a commercial structure, you can depreciate it over 35 years. That's like the standard. So if you paid $1 million for it, what's the math on that? 35,000 a year, or 100,000 a year, whatever. Someone do the math. You can either do it over 35 years. If it's a residential structure, you can depreciate it over 27 and a half years. Or if you're a real estate professional, so maybe you manage your own properties, you're a real estate agent. I don't know if lenders would qualify, you might. Or if you're a contractor, you can buy a rental property. So I'm not good at math, so let's say you spend $100,000 on the rental property. The land's worth $10,000, so you have $90,000 in building and improvements. You can either take that $90,000 over 27 and a half years, let's call it $2,600 a year in tax write-offs, or you could take about $50,000 of that in 1 year as a cost segregation or accelerated depreciation. So that would mean that the first $50,000 you made every year, the first $50,000 you made that year would not be taxable because you were able to accelerate the depreciation on it. So if you were to buy one little guy every single year, you would have a massive tax benefit and you may not pay any taxes. Like you hear about these billionaires that don't pay taxes, these are the kind of things that they do. Because now if you're a real estate professional, a house is a tool because that house is making you money every month. And you can take that tool and you can drop its value on the IRS's books. But the only downside to that is if you are to sell it, you then have to recapture all the write-offs at the earned income rate, which is why we have a 1031 exchange. Anyone ever heard of a 1031? That's a tax-deferred exchange. So now maybe I bought 10 of these over the past 10 years. They're worth $1 million, but the basis, what the IRS sees me have value in, is zero. So if I sell them, I pay taxes on $1 million. But I could sell all of them and utilize a 1031 exchange and buy something for $2 million and have that tax liability get pushed into the future. And I could continue to do that, getting more and more real estate, taking more and more depreciation. And then when I die, the cost basis resets to the market value the day I die. So then my kids don't have to pay those taxes either. So that is one way, if you're a real estate professional, that you can save an immense amount of money in taxes. Like there's people, you just buy one duplex a year, one single family house a year, and do that, there's a good chance you'll pay very little to no taxes. My tax rate was 8%, and everyone's like, how'd you do that? It's that simple, and I do it a lot.
Okay, so if I've got a rental, but it's not free and clear, like some of the expenses of the rental are taken out of the rents that are paid to me.
Okay.
So
you got maybe
have all that. Like I might not even have that much that is taxed because it's going back into the rental, right?
So you're not a real estate professional. This is what it looks like for you. You get $10,000 a year in rents.
Right.
You can have $10,000 in expenses, and you can get to zero.
Right. Okay.
To where you didn't pay taxes on this.
Right. Okay. So
because you're not a real estate. So this would be any money you make on rentals, if you're not a real estate professional, is passive.
back into the rental.
And if it's passive, it's taxed at a lower tax rate because it wasn't earned. So when you work hard for your money, you pay more in taxes. When you don't work hard for your money, you pay less in taxes. But the IRS says you cannot take a loss on this because you didn't work for it. But for me, I can add a 1 in there because I work for it because I'm a real estate professional. Even though someone else may manage my property, now I could write whatever the cost of this puppy is. It's called a cost segregation where you guys ever see IKEA furniture? Or it's like this diagram that's blown out. You have like the outside and all the screws go in, then you have the shelf and the shelf. So that's what a cost segregation does. So they say, okay, this tile ceiling here has a 10-year life. And it was $100,000. So you can take $10,000 for 10 years, or you could take all $100,000 up front by accelerating the depreciation, and then the nails and the screws and the cabinets and the floors and the paint and the roof, they all have different lives according to the IRS. So the simplest thing to do is just take it over 27 and a half years. But if you're a real estate professional, you could wipe it all out in 1 year. So let's say Kat made $1 million and she's a real estate professional and she has $2 million worth of rentals. She could accelerate the depreciation to where she doesn't pay any taxes on that $1 million. through this process. And the only way she gets stung is if she sells it and doesn't do a 1031 exchange. Does that make sense? But if Kat's not a real estate professional, she can just get to zero. So she can have the rent, get offset by the expenses, but she cannot take a passive loss. So that's why I get excited about rents.
If you don't do a 1031 exchange, what's your rate of taxation? Is it based on the state in which you live, the state in which you moved to? If you are to move to a different country, what is that taxation look like?
Good question. So there's going to be two things that occur here. There's going to be a capital gain, and that's going to be taxed. The state of Oregon's long-term capital gain, anyone know what that is? Is it 10% or 20? And then the Fed, I believe, is 20. So, April, do you know?
No, I forgot. I'm pretty sure it's 20.
Yeah, because Oregon's state income tax is 9.9. So you're going to pay the 9.9 on the gain, right? So let's say I bought it for 100 and I sold it for 200. The extra 100 is a capital gain.
50%.
But 15. Okay, but then the depreciation part, so the part where I accelerated the roof's life down to 1 year so I could get a big tax break, that's going to be taxed at earned income, which is going to be 30-40%. So if you sold it for $1 million and you bought it for $500,000, the first $500,000 that you purchased it for, minus the land, would be taxed at earned income, which would be brutal. So let's say 40%. And then the rest would be a capital gain. Let's say that's taxed at 25 or 30%. So that's why there was talk about 1031 exchanges going away. That would further complicate real estate because you'll have all of these people that own rental properties. If they did accelerated depreciation or if they didn't, over time, you're going to be depreciating this asset with the IRS. Now remember, depreciation is just shrinking its value on the books with the tax man. It has nothing to do with the actual value of the asset. That will continue to go up over time. But what you show the IRS is, oh man, this thing that is worth $500,000 on the books is worth zero. I took all of my depreciation up front. So that's where the problem would be, is that they would never sell. It would be no point to selling it because they would pay pretty much everything in taxes, or half, right? So I've got $10 million worth of real estate. I've depreciated all of it over my lifetime of owning these for 40 years. I just wouldn't sell them. And that would be a huge problem for us to be able to continue to move properties around. You ever deal with 1031s, Mike?
I mean, not a lot because typically they're, I mean, here and there, but typically they're, a lot of times they're not needing a mortgage or they're buying, a lot of times I've seen bare land.
Cash.
Using cash and stuff. So no, not a ton to be honest.
Everyone see the little USA? So this is a map of the United States of America. And the little percentages are month-over-month changes in inventory. So inventory is a calculation of what's called an absorption rate. So if 100 homes sell a month, and there's 100 homes for sale at the end of the month, there would be 1 month of inventory. So that means that if no homes hit the market, and we keep selling 100 homes a month, at the end of the 1 month, all 100 of the homes for sale were gone. Does that make sense? So if there was 100 homes a month selling, and there was 200 homes on the market at the end of the month, we would have how many months of inventory? 2. If we kept selling 100 homes a month, but there was 300 homes for sale at the end of the month, we would have 3 months of inventory. So that's all that inventory means, is simply a calculation of homes sold in a month versus homes available for a month. And what we're seeing is a slight uptick in inventory, but nothing really significant, except for the new construction guys. Sorry. Nationally, new builds hit 9 months of inventory. What that means is, at the current rate that people are purchasing new homes, it would take 9 months to buy everything that's currently for sale. That means if we continue putting new homes on the market, that would increase the amount of inventory. So what we do know is once you hit 6 months of inventory, prices start to go down. So we're seeing new construction take longer to sell because there's more available and there's less people buying it. And we're also seeing some price corrections in the new construction market based on the inventory. But existing homes, they're up a little bit. So what happened is we had prices that were too high. Has anyone looked at Zillow like 6 months ago or like, are you kidding me? How are my kids ever going to buy a home? How am I ever going to buy a house? Kind kind of getting kind of nuts. So a house is worth 400, but we'd be like, I could probably list it for 440 and sell it for you. And then it sold for 450. So what first has happened is that fluff on the market has gone down to now the house is worth what it's worth, not like pricing ahead of the market. But now buyers have rebounded and they're saying, okay, the market value of your house is worth 4. You used to think it was 440. So the seller's mad because they think they lost 40 grand that they didn't. But now the buyer's saying, I think it's worth 350. So now the buyers are pricing ahead of the market, seeing the market start to come down. And that's because they're seeing and hearing on the news, like Mike had mentioned, the media's got it all wrong and they're screwing with us?
Yeah, I mean, what's the media saying about interest rates? What happens every time the Feds announce that they're going to raise the interest rates? What happens? Fear? Yeah, right. That's how that runs. So, and what people don't understand is when the Feds announced they're going to raise the interest rate, did that directly affect the 30-year rates today? No.
Seemed like it.
Didn't. It seemed like it. Sometimes they can actually go down, and a lot of times we've seen them go down. So it's just economic news that drives the long-term rates. That's the overnight rate, is the Fed rate. Okay, so when they change that, so a lot of times interest rates on the long term they will raise ahead of the Fed announcing a rise in interest rates. So bottom line is there's a lot of negative rhetoric around the interest rate environment as a whole. I think we can all agree on that, and that puts a lot of fear in people's mind, and then they freeze. Even if they want to buy, they don't. They're terrified, or maybe Steve's building them a house. And they're like, well, these rates are rising and rising and rising. What happens if they keep going and I can't afford my payment at the end? And Steve's thinking, oh my gosh, what happens if they can't qualify for the house anymore? And now then what's going to happen? So hence why we're starting to see people get a little bit frozen. And so a lot of what I'm doing right now is working with solutions on how do we mitigate that? How do we do longer term locks right now, so we can make sure to give people, the builders and clients alike, that the safety of a lock for 6 to 9 months. How can we do that? And then since things are getting softer and sellers are being more negotiable and builders are being have to be a little bit more negotiable, so we can move things. So maybe we're going to give you a credit, and maybe that credit is going to lock your interest rate for 9 months. So I can get this place built. I know you're going to be qualified at the end. And so, again, it's just...
do that?
I can do that. You betcha I can do that. Yep.
Can you touch on, so who here thinks that when the Fed raises rates, they're raising mortgage rates? What you said, it's the overnight rate. Can you dig into that a little bit? So the Fed announces, right, they meet every 6 weeks, a Federal Open Market Committee, and they say we're raising rates by 75 basis points, or 0.75%. What are they raising?
Yeah, so the over, and I'm not perfect at this, so forgive me. So the overnight rate, yeah, it's super on the spot. Geez Louise, didn't even give me any notes to go off of or nothing. Deer in the headlights, no.
United States.
So yeah, the Fed overnight rate, again, it's the bank overnight rate. It's anybody have a home equity line of credit? Ever get a home equity line of credit? Okay, that will change. Okay, that changes real quick with when the Feds do an announcement.
Yeah, they move every month, right?
Yeah, yep. So go ahead.
Specifically, banks have to balance every night, and they lend each other money to make their books balance. So it's a literal Fed overnight funds rate is all that is. So what Wells Fargo charges U.S. Bank when they need $10 million to zero their books out for the night, that's what they're raising. Because we're tied to the 10-year Treasury, 30-year mortgages, right. Correct?
Yep. And that is spurred by economic news. And that could be news in China, could spur economic news, which in turn spurs stocks and bonds to move upward or downward, which in turn will spark interest rates, 30-year long-term interest rates to move. And it could be the silliest of things that could make those move up or down. Again, today we saw a ginormous rally for the better for the bond market, which creates the 30-year longer term interest rates, because a report came out that gave everybody this confidence that maybe we're going to get through this inflation thing. Okay, and that's the big thing. And what are the Feds? Why are the Feds raising this overnight rate? Because they're trying to curb inflation. They're trying to slow this craziness down to get on the other side of this. And so the good news is, on the other side of it, history shows that, hate to tell you, but recession typically comes, okay? And what happens during recession for house prices?
They go up, Michael.
Yep. Okay, so, and guess what rates do?
They go up too. Down?
Do they?
I don't know. I don't know.
They go down.
What we're doing is we're
down.
confusing the hell out of you, so you have to come to us. Just by the way.
Yeah, they historically go down again. Nobody holds the crystal ball, but history repeats itself over and over again. Okay, it does. So how many of you are scared to death that this is another blow up? That this is another boom? You know, everything's going to go to heck in a handbasket. From
Cat's a little
what
bit
happened.
scared.
A little bit scared. Anybody else? Or
Mama Newman over there.
Okay. Nobody is. Awesome. Then Adam's educated you well then, because yeah, this is what's that?
It's the wine.
It's the wine, yeah.
We're fine. It's fine.
Yeah, a little hour ago, right. So bottom line is this looks nothing like, smells nothing like when everything blew up back in 6, 7, 8. Okay, it's a way different on so many different levels, and I don't think I need to get into all the details. But bottom line is, how much inventory was there back then versus there is now, even though things are changing inventory wise.
So I started in 2011, and there was like 12 months of inventory. So that meant if no homes hit the market for a year, then you would finally run out of homes to sell at the current home sales pace rate. Now we're across the nation, residential is hit 3 months. So new construction is getting battered because it's at 9 months. So we're seeing new construction stop. We're seeing lumber prices fall. But as far as like standard residential, we're only at 3 months. When the market started to get shaky in 2006, 2007, we were at 7 months of inventory at that point. In Medford, we're holding around 2 to 2.5 months of inventory. So as homes hit the market, they're still selling. And also what's happening is people are like, wait a minute, my payment's $2,000 a month. If I bought the same house today, it'd be $2,800 a month. We're just gonna stay. Our house is worth $150,000 more than we paid for it. We don't wanna really double our mortgage, right? Because if you sell that, you lose the rate, and then you go buy a bigger house with a much bigger rate, the down payment's not going to be enough to offset that additional expense. So people are just like, we're just not going to sell our house right now. And when that happens, that's why we're only seeing like a slight drop in values. The 10% that we've seen really is like the removal of the fluff of the value that was never there from April. Remember when I list it, I say it's worth $400 and we sell it for $440. Now it's selling for $395. Now it's selling for $390 because that's what the market's doing. But it's not going to go to $300 because there's not anything to buy. It's still pretty tight. Anyone out there looking for homes right now? There's still not a ton of stuff out there, Steve. Yes. We can't sell them for you, but you can buy more. But what you are seeing, this is on page, I don't know, because I printed this like 5 minutes ago. It's existing home sales. So what we're really seeing is the poor real estate agents. I'm going to pass out a cup for donations after this. Volume's down 30%. So values aren't down 30%. If we were selling 1,000 homes a month, now we're selling 700 homes a month. So the number of sales is decreasing, but values have more or less stabilized at this point. We dropped to 10. We're not seeing much happen. A bunch of the big smart people think maybe we'll go down 5% next year and then go up 5% in value the following year, but volume's down. So lenders are really getting hurt by this because half of their business, or not all of them, but your typical lender, right, half of your business is refinances. Well, if you got a 3% interest rate, you're not going to refi a 6%, right? You're just going to hold. Title companies are getting whacked because half of the title companies' business are doing the title work for refinances for lenders. What are you seeing like the average lender? I know you've done more purchases, which helps you be more recession resistant. Yep. What do you think the average lender is down as a percentage?
I'd say some people that are super refi heavy, I've heard as much as 75% decline. And I don't know if you've heard, but a lot of banks are going out of business or they're getting out of the mortgage space. And all kinds of crazy stuff. Numbers are drastically changed. But we came off of 2 years that were unbelievable. Because who didn't take advantage, whether it was a refi or a purchase in the last, within the last 2.5 years? Raise your hand if you did take advantage of rates in that amount of time.
I bought everything I could.
Unbelievable, incredible. Let's put some perspective on that just while I'm talking. What perspective on interest rates at 3%? Is anybody making any money on that? Anybody thought of that? I was too. But guess what? Were the investors making any money? No, because they had to pay me. They
I
had to
always
pay my
wondered that.
staff.
It's like, who the
They
heck?
had to, oh, guess what? I'll tell you what it was. The government stimulated it with about I think it was 2.4 trillion. Yeah, that's a lot of money. That was not, it was real for some of us because we really got those rates, but it was not real. In other words,
See if I can do this.
don't expect those rates to ever happen again in our lifetimes. We're just not going to see them. So, like Adam said, what is the new reality going to be when rates do correct? Because they're kind of doing this. When they do correct, what's that new reality
Is
going
that
to be?
is that it? Is that 2.4 trillion? Is that?
No,
Woof.
you need 3 more zeros.
Really?
3 more zeros.
Good God.
Yeah.
Okay, we're doing this thing. So that's why we got those cheap rates. So on that note, I think food's probably ready. So you guys are more than welcome to get up. And then if you have questions, we'll just hang out up here. Or comments.
Mike, I have a question for you. I know because we, like you mentioned, the last 2 years, 3%, 4%, everybody's, it was like goo-goo. But even at 7%, when you look at history, my question to you is, when you look at history, 7% is still a good rate, is it not?
Yeah, it is.
Okay.
Yeah.
Then
Historically.
As long as we look at it in, like he said, in the 80s, it was 18%,
Yep.
5.5%. Yeah. So it's really, we got to just take the shock off, I'm guessing.
Yep.
Off
Yep.
7%.
And so what it allowed for when these rates were really super low is it allowed for people to buy that maybe couldn't have never bought before, and maybe it gave them the opportunity to actually be able to purchase, and maybe they were never going to be homeowners because they couldn't afford it, but they did. So they got in the real estate game, and now it can be a lot of fun. But that was the reality, and now we've got a lot of people that want to be in real estate. They want to purchase real estate, and some of them can't because of the rise in interest rates. So now, guess what? What we're starting to see is 40-year mortgages talked about. We're starting to see different interest-only products and all this kind of stuff. And so it's very interesting to see the navigation that's happening and the solutions that are happening for people to get into the business. You first, and then I got you.
Are you guys seeing back to variable rates, or are you still seeing the fixed rates first and used?
So that's a good question. So we are seeing variable rates. I just wrote my first one since the very first one I wrote in my career. So I've done 2 in my career, 17 years.
The issue in 2008, right? That was a lot of the bubble.
Predatory.
Exactly. So let me clarify what a adjustable rate mortgage is, because it was used abusively then. Okay, you can't really use it abusively now, because guess what? You can't qualify at the interest rate on most of the ARM adjustable rate mortgage products. You cannot qualify. We cannot qualify you based upon the rate that it is. We have to qualify you based upon the rate that it could be. Okay.
Shoot.
So not the tippity top, but bottom line, it's not the lowest rate. Okay. So there's protective measures in that. But adjustable rate mortgage, guys, for the right person, and especially in this climate, the one that I just did was for somebody that had a shorter term plan. So it is a fixed rate for an allotment of time. 5 years, 7 years, 10 years, okay? It is fixed for that period of time. It does not adjust until after that time. So guess what? My people that were going to buy or were going to sell and do something different within 3 years, what did I do? I explained it, gave them the options, okay? We did a 5-year ARM for them, okay, because it's fixed for 5 years. So they have 2 years beyond their 3-year plan if something was to change for them to still be able to navigate that and make the move that they want to make. Okay?
How much was the rate lower than par? Say par 7%. Like, what's the difference there?
and I don't remember exactly, but I feel like it was 3/4 of a point to maybe a percentage point better. So again,
I was hoping for 5 or something cool.
yeah. Well,
No?
not really. So you have to weigh out, the pros and the cons of whether or not that's going to make sense, the risk versus, and a good mortgage lender is going to show you, not say, oh, this is how you get a cheaper rate, let's do this, let's sign up for that. No, let's look at the 30-year, let's look at a 5-year ARM, let's look at 20% down, let's look at 15% down, let's look at all these different options, and you tell me what makes the most sense. not the mortgage lender telling you what makes the most sense, right? And so that's the hope, is that professionals doing it that way. You had a question too.
Yeah, so when interest rates go up, how long historically do they typically stay up before they start going down again?
Gosh, I
Probably
wish I knew
forever now. So one of my little thingies in here, should have numbered these. Next time I'll number them. They're thinking it's going to be 6.5%, 7% like through next year. We're kind of at maybe the highest now, hopefully. But the new normal is probably going to be 6, would be my guess, because we don't have these big dollars buying the rate down for you. So will we ever see 3% again? We don't really know, but it's pretty doubtful.
And
So
honestly, as much as we all want to see that again, because it would help me, it would help you sell houses, okay, it would help me do more mortgages, all that kind of stuff. Honestly, the big picture is I do not want to see that again. Why? Because that's not good for our economy. And now we're paying for that. We're paying for that now. And so that's the reality of it. So yeah, short term, yeah, it's awesome. We can make money and stuff, but the reality is, hey, guess what? This has a price. It has a price, and we're going to pay for it for a bit, and that's just the reality.
any other thoughts? Going once, going twice. All right, Bum Rush Rosarios.